Hello traders, this is Alexander from the Forex Authority and the FX Model Software. Okay, what I wanted to look at today was a swing trader's perspective. Let's have a look at the last year on the swissy, that's the CHF, and on the daily time frame. And the first valid trade signal that appeared was this sell with trend dot. And in order to calculate price of entry and exit, let's have a look here at what it says. The daily chart, the validation rule is 50 pips above or below the candle high or low. So in other words, we want the market to show its hand, and if we look at this particular candle right here, we want the market to go down 50 pips below the low of this candle prior to us entering. So in this case, if we look at the low of this candle, the low reads 1.2054, and so our entry price would have been at 1.2004. We would have had a sell stop order resting at 004, and we would have been, that order would have been filled at this bar right here. We did get an opposite dot, a counter trend dot, and what we would have done is we would have exited our position on the validation price of this particular candle right here. So we hover our mouse over that, and the high of that candle was 2064 plus 50 plus your broker spread works out to 2114. In that case, we would have been minus 100 pips. And we'll just keep track of that here. And the next valid trade signal was this sell with trend dot that appeared right here. And if we hover our mouse over that candle, you'll see that the low of that candle is reading 780. And if we subtract 50 points from that, that reads 730. You would have placed your sell stop at 730 and been filled on this candle right here. And stops would have been placed above the previous swing. And in this case, the market continued to move downwards. The first opportunity to exit was on this counter trend dot that appeared right here on this candle. And if we look at the high of that candle, it reads 1.1036, and we add 50 pips to that, plus a couple pips for broker spread. So you would have exited at 1.1086, we'll call it 88, and you have a net there of 640 pips or so. So that was an excellent ride on the swissy. And then moving along, our next opportunity for entering the market. Our next opportunity was this counter trend dot, and again looking left, no clear structure support to the left. We do have resistance, so if you had taken that, you would have entered the trade down here. If you had simply waited, you would have entered on the super dot sell signal that appeared on this candle here. So let's take the worst case scenario and assume that you waited until this super dot sell signal. And we'll hover our mouse over that, and you can see that the low of that candle reads 1.1376. So we would have entered at 326. We would have had a sell stop order resting at 326. Sorry, 326. And the market continued to move downwards with opportunities to move your stops. And we would have exited on this counter trend dot here, which reads a high of 1.022 plus 50 pips is 1.072 plus broker spread, so we'll call it 74. And the total turns out for this run right here to be a total of 250 pips. That was a nice 250 pips. And since that point in time, we did not have another sell signal. There was a sell signal here, which I'll temporarily turn on. And you can see that dot. The sell signal dot did appear in order to try and take advantage of this downtrend. However, within 5 bars, 1, 2, 3, 4, 5, this dot had not validated. So if we look at the low of that candle, it was 887. So an entry price of 837 would have validated that candle. And if we look, it just simply did not reach the low of 837. It reached 838, but it did not reach 837. So that particular candle was not validated. So we are not going to count that in our tally here. And moving along, the next opportunity for a trade was this counter trend dot. However, this dot was not validated because there's no structure to the left and there was no divergence present. So moving along, we then moved into a series of counter trend dots. And had you taken any of these, you would have had to, had a look at whether or not structure or divergence was present. And as you can clearly see, you would have picked up 50 and lost 50, and so on. Lost 50 on this one, and then on this one right here. So we'll just call that a net, minus 50 pips right there. We'll jot that down on this choppy market here. And the last opportunity to trade was on July 16th, and if we hover our mouse over that, we had a high of 186 plus 50 is 236. And with an opportunity to trail stops at this point, so we had a close above the last pivot or higher high, we would have had our stops below this, and we would have been locked in probably a good 50 or 60 pips at this point right here. So I'm just going to scroll back and just have a quick look at what the total of our pips is. We're going to go minus 50 there, 200, so that's 200 pips right there. We've got 840 pips and minus 100. So that's 740 pips in total. That's on one standard lot, and depending on your account size and risk management, that would determine how many lots you would be trading. So as you can see, the FX model did a great job of picking out the trades for that year in the Swissy. On behalf of the Forex Authority, I'd like to thank you for joining us today and watching this video. And I invite you to visit our website at www.forexauthority.com for more information, or to join our free informational newsletter, or to sign up for a live demo of the software. And if you'd like to email any questions or comments, please contact us at info@forexauthority.com.